Hello everyone, welcome back to LGT Services YouTube channel. Today we're going to talk about some of the fundamentals when we're filing taxes. We're going to go over some terms and some standards that all tax preparers use and that you might see when you're filing on your own. My name is Nicole. Please hit those like and subscribe buttons before we get into it. One thing that people commonly get confused in their heads is the filing year and the tax year. When you're talking to a tax preparer, like myself, you will hear people say, oh yeah, the year 2019. I am talking about the tax year 2019, not the filing year. You file your taxes almost a year after. So for this coming April 2021, you will be paying your taxes for the year 2020. You file in 2021 for the year that has passed already, the full year, January to the end of December mostly. That can vary depending on your status. Okay. Another thing, let's talk about the difference between qualifying child and a qualifying relative. They are not the same thing. I know your child is your relative, but they're not the same. So a qualifying child needs to meet a 4-point test. First, there is a relationship test. The relationship test basically consists of if they are your child either through marriage or if they adoption, or there's a couple of different reasons why they could be your child. It's not just straight blood children. The second test is an age test. Are they younger than 19? If they are over 19, they need to be younger than 24 and be considered a student. There's a little bit of difference in what a student is considered, but in general, they need to be taking a 12-unit load at whatever university, trade school they're in. And they need to be younger than 24, not 24, as well as if they're not a student, they need to be younger than 19. The third test is a residency test. They need to have lived here for more than 6 months. Of course, there are some variations, meaning they can't be in Canada or they can be in Mexico depending on the circumstances. There is one thing to note. When they're away at school, if you have a 20-year-old and they're off in college, or if they're in boarding school, that's still considered living with you because that is their primary residence. You are their primary residence. So don't worry if they're gone for 9 months out of the year, that they will still pass the residency test. And the final test is a little tricky here, but it's very important. This final test is that that child cannot have provided more than 50% of their own support. That means somebody else or multiple people could have provided the majority of their support as long as they specifically have not provided more than 50% of their support. You'll see this again, but a little bit different when we're talking about qualifying relatives. So if your child meets all 4 of these tests, relationship test, age test, residency test, and support test, they do qualify as a qualifying child. Qualifying relative is a broader designation, and this is where you're going to get into for the people that you support but are not considered your child. So there is a 4-point test for this one as well. First, we have the relationship test. If they're a family member or something similar to this, or if they have lived with you for 100% of the year. It's either the relationship or they have lived with you. They do not need to be family to be considered a qualifying relative. The second test is a gross income test. They cannot have more than $4,200 of gross income. This excludes Social Security in most cases. Not all, but in most cases. The third test is a support test. For this one, you as a taxpayer need to have provided more than 50% of support for them to be a qualifying relative. This is different than the this is different than the support test for a qualifying child, because in a qualifying child, that child cannot have provided more than 50% of their own support. In this case, for a qualifying relative, you, the taxpayer, need to have provided more than 50% of the support for the qualifying relative. The fourth test is an easy one. It's just that they cannot be a qualifying child for anyone else. That's it. Now, depending whether they're a qualifying child or a qualifying relative will affect you when we're talking about the credits and deductions. Let's go into filing statuses. So there are generally 4 different main filing status that people can qualify for. You have single. So the next filing status is married filing joint. Married filing joint includes same-sex marriages since, I believe, about 2013. Then this is the most ideal status. Married filing joint is the best of the best. You cannot get a better status than married filing joint. Then next, after married filing joint, we have married filing separate. This is the worst, the lowest of the lowest statuses, the least amount of options with this status, and the hardest hit via with taxes. If you are separated and you have a decree from a judge, then you can go ahead and either file single or head of household. Do not elect to file married filing separate. If you are estranged from your spouse and you don't have a decree, talk to them, speak with them. It is mutually beneficial for both of you to use married filing joint instead of married filing separate. Keep in mind, one person can't be married filing joint and the other person be married filing separate. You do need to have this discussion. There are some things that can help out some people. For example, they have no idea where their spouse has been and they can't get in contact with them. There's some things that can help you out with those. And then there's also a few things that can help you out after the fact. Then our fourth status is head of household. Head of household is basically you're single or some sort of version of single, but you are taking care of someone, whether it's a qualifying child or a qualifying relative. Many people that used to be married filing joint are now considered head of household for whatever reason. Our final status is what we call a qualifying widow or qualifying widower. This is because your spouse has passed away, not in the year that they passed away, but the 2 following years after they passed away, depending on certain requirements. If you can meet certain requirements, this status is similar to married filing joint. Okay, what are the importance of the statuses? The statuses let me know what deduction you can get. So we have the standard deduction, which is a deduction that is given basically to everybody. The amounts change depending on your status, but the standard deduction is the general one that most people use, especially now. I say especially now because the TCJA, Tax Cut and Jobs Act, increased the standard deduction. So as a result, more people use the standard deduction instead of the itemized deduction. So you have 2 options, a standard deduction or an itemized deduction. You cannot do both. You have to pick one or the other. The itemized deduction used to be very beneficial for people with assets because you could take a deduction here for this and for that and for that. But remember, each item has their own limitations and their own requirements. But now, because of the TCJA, which was implemented by Donald Trump, the standard deduction has risen and a lot of those itemizable things are no, they're gone. Gone. Oh, so gone. So most people are using the standard deduction. I mean, think about it. Going item by item, it's pretty difficult to find $24,000 worth of deductions. And even if you did find $24,000 worth of deductions, you might as well just take the standard and not waste your time finding that, because you have to go item by item. However, if you send it to a tax professional, that's what they're paid to do. So they'll do it, and it's a little bit easier for us because, you know, all of that information is fresh off the top of our head. Okay, so let's go into the standard deductions for the tax year 2020. You'll be filing in 2021, but I'm talking about the tax year 2020. Okay, for married, filing, and joint, the standard deduction for the tax year 2020 is $24,800. This is a $400 increase from the tax year 2019. For married filing separate and single, it's $12,400. This is a $200 increase from the tax year 2019. And for a head of household for the tax year 2020, the standard deduction is $18,650. This is a $300 increase from the tax year 2019. Standard deduction increases are always good things. They usually kind of follow the trends of inflation unless there is a huge shakeup with the IRS. And as I said, with every new president, we have a huge shakeup. If you want some more information about that, click here to check out my other video. Okay, so you guys have heard me say a lot about deductions, standard deductions, and it's kind of like, well, what does that all really mean? We have two great things in our tax system. We have credits and deductions. But which one is better? A deduction is better. Let me tell you here and now. A deduction is better. Hear my words. A deduction is better. Why, you ask? I can explain. A deduction reduces your taxable income. Your taxable income is how they figure out how much you owe, while a credit reduces your tax liability. I would rather have less income for them to figure out how much I owe in taxes than them figuring it out and saying, okay, we can reduce it a little bit. No, thank you. However, I'm not going to throw a credit out the window. It's just if I have a choice between a deduction or a credit, and there are quite a few things where you can choose to take it as a deduction or you can choose to take it as a credit, but 9 times out of 10, I would rather take it as a deduction. Let me go ahead and explain to you a little bit about the math so you can kind of understand it a little bit better. We start with our gross income. Your gross income is how much money do you make. All the income streams put together, how much do you make? Usually people have 1 to 2 streams of income. This will be from a job, which will get their wages from, and then on top of it, they might get some dividends, some distributions from stocks, or they have like a rental property or some source of other passive income. So when you add all of those streams together, you get what we call your gross income. From your gross income, we subtract some adjustments for various reasons, and that is how we get your AGI. Your adjusted gross income. Your AGI is your adjusted gross income, and this is what people use for most things to see if you qualify for this or you qualify for that, or you phase out of here or you phased out of this, whatever it may be. From your AGI is where we take away the deductions. Of course, you take away your standard or your itemized deduction, not both, one or the other, whichever is larger. And then you also can take away most of the other deductions. We call these above line deductions. Most of them are above line. Some of them you have to figure out your taxable income before you're able to take those deductions. So from your AGI, we take away your standard deductions and some other deductions, hopefully. Then we get what we call your taxable income. Your taxable income is how they compute how much taxes you owe. So let me give you some examples. Imagine you have $100,000 of taxable income and you're at a 20% tax rate, so you'll owe $20,000 in taxes. From your taxable income is where they add the credits, which basically is reducing your tax liability. So if I owe $20,000 in taxes, and let's say I have $2,000 worth of credits, now my tax liability is $18,000. But as I said, I would rather reduce my taxable income than reduce my tax liability. If you take it away sooner, it will make a bigger impact. This is just how the math usually works. Well, those are the fundamentals for filing our taxes. In our next video, we're going to talk about some of those credits that people love and some other ones that are not used all the time. We're going to talk about the goods and the bads of each of these credits, how to qualify for them, and what to be careful for when you are electing to use one or more of these credits. Thanks again for watching our video. Check back here for some more great tips and information about your taxes. If you haven't already, hit that subscribe button and I'll see you guys later.